Warren Buffett's Investment Philosophy, a Comprehensive Guide. I began investing when I was 11 years old, though I had been thinking about it since I was 7 or 8. Those early years were largely wasted. When I bought my first stock at age 11, I experimented with stock timing, charting, and all sorts of techniques. It was extremely exciting, though not profitable. I continued doing this until I was 19. I read every investment book in the public library. It was absolutely fascinating to me, but I had no real framework. I was simply searching for something. I hoped that little patterns on charts would tell me what a stock was going to do. It was somewhat crazy, but since everyone else was doing it, I figured I should too. Sometimes I'd turn the chart upside down. That didn't help either. Then in 1949, I read The Intelligent Investor by Benjamin Graham. I'd never heard of him before. There were really only 2 key chapters in that book, but they established my entire investment philosophy in 3 ways. These principles are so basic and simple that it's hard to understand why they're so important. The 10 Commandments are simple too, right? The first principle is that a stock is part of a business. You can't think of a stock as something separate. You value a business and then divide by the shares outstanding. But you have to think about what kind of business you're getting into. Its economic characteristics, its competitors, its management, all these things that relate to a business, not just some ticker symbol. When I was 11 or 12, I knew the ticker symbols of nearly every company on the New York Stock Exchange, but I didn't actually know anything. I knew that X was US Steel and T was AT&T, but I didn't know what was behind them. So I had to start looking at these little symbols as actual businesses and figure out how to value a business, what really matters. The second key idea in Graham's book is how an investor should react to stock market fluctuations. He introduces his mythical Mr. Market in Chapter 8. Nothing better has ever been written about an investor's attitude toward stock prices. Most people react the wrong way to stock prices. They feel good when stocks go up and bad when they go down. They think the stock market is there to instruct them. Mr. Market is your investing partner, and he's remarkably obliging. He shows up every day and tells you what he'll pay for your interest in the business, or what he'll sell you more for at the same price. No one does this in private business. If you and I owned a gas station together, and I said you had to come in every day and offered me your half interest, and I could either buy your half or sell you mine at the same price, you'd be at a huge disadvantage. The beautiful thing about Mr. Market is that he's a manic depressive alcoholic. He's as unstable as they come. He wanders around all day looking at crazy things and throws out all kinds of wild prices. You don't have to pay any attention to him except when it's to your advantage. If that's once a year, once every 5 years, or one stock out of 3,000, you just sit there. You have no moral responsibility to this fool. He's throwing out these numbers. You didn't ask him to, but he's doing it. All you have to do is wait for the moment when he's particularly depressed, particularly manic, or particularly drunk. The market will be all these things and you take advantage of it. That's what's remarkable about stocks. If you look at the high and low prices of all these American companies over the past year, you'll see case after case where the high was double the low. These are solid American businesses, operating normally, paying people, selling goods. If you look at farmland 10 miles from here, there's no way its value will swing from X to 2X. Maybe it goes from X to 1.10x. If you look at an apartment building nearby, its value won't move more than 10% in a year. But here we have the finest American businesses, and people are just throwing out numbers that swing wildly. You don't have to play unless you want to. That's the key point. That's what Graham teaches you. The market isn't there to instruct you. The market is basically there to serve you when you want it to. One of the most important things to remember about stocks, though it's very hard for people to grasp, is that the stock doesn't know you own it. You're sitting there with Berkshire certificates. The company doesn't even know you own it. The stock is trading right now, and they don't know you own it. So it has no feelings about you. It's just part of a business. The third principle in Graham's book is the margin of safety. If you come to a bridge that says it has a 10,000-pound capacity and you're driving a 9,800-pound truck, you should find another bridge. Nobody knows exactly what that capacity is. The sign might have been put up 3 years ago. You always leave a margin of safety. You don't try to cut things too close. You wait until something practically shouts at you. With these three principles, you can build all kinds of structures, but this is the foundation. If you have this mindset, and it's all in the intelligent investor, I've never found anything that even comes close. You can't remove one leg of this three-legged stool and still have a sound investment philosophy. I'd say the most important thing over the long term, especially when working with large sums of money, is understanding the business. Suppose you were given $1 million and had 1 week to buy any three businesses in Tennessee. Private businesses, not publicly traded. What would you do? You'd look for businesses with durable competitive advantages. You wouldn't buy a Burger King franchise just because nobody's within 10 miles yet. You know Wendy's and McDonald's will show up soon. You'd look for something with an enduring competitive advantage, a business with a moat around it. By definition, capitalism is a system where, whenever someone has an economic castle, someone else will come after it. If you open a successful restaurant in town, someone will copy your menu, steal your chef, undercut your prices. You want a castle with a wide moat. There are many ways to build a moat: patent protection, location, or mind share like Coca-Cola. 6 billion people worldwide have something in their minds about Coca-Cola, mostly favorable. They have nothing in their minds about RC Cola, even if RC spent $1 billion on advertising. Coke wants to be where people are happy, at theaters, Disney World, the World Series, always associating their drink with happiness. That's why they'll sell vast quantities, even if someone else is half a cent cheaper per serving. You want management that's able and honest. But the best businesses are those where even a fool could run them. Peter Lynch said, "Buy a business so good that an idiot could run it, because sooner or later one will." Recently, some students asked me, "What will happen to Berkshire when you go senile?" I said, "Berkshire's so good that I can go senile. In fact, I may already be." You want a sensible price. If you had a week to look around Tennessee, you'd immediately eliminate many options. It's crucial to know what to exclude. 30 years ago, The New Yorker had a great article about Bobby Fischer's chess match against Spassky. It explained how the human mind can filter billions of possibilities down to 3 to 4 real options. Investing is similar. If someone told me my life depended on picking 10 Dow Jones stocks that would outperform the index, I'd start by eliminating the worst companies. That's an easier approach than picking the 10 best. In Tennessee, you'd exclude many industries. Maybe car dealerships are too competitive. Who knows if Ford or GM will dominate in 5 years? You'd say, I'll skip car dealers and focus elsewhere. Apply that same approach to the stock market. There are 3,000 companies on the NYSE tonight, each with a price that'll change tomorrow. You don't have to act every year. If you have 5 good ideas in your lifetime, you can get very rich. I tell students they'd be better off with a punch card allowing just 20 investments in their lifetime. That way, instead of buying some stock after a cocktail party tip, they'd think deeply about each decision. At Berkshire, we never want to buy anything small. We focus on what can move the needle. As capital grows, this gets harder, but that's the right approach.